Well, hi, everyone. My name is Chad Sluss. I am the Executive Director with the National Equipment Finance Association. It's my pleasure to say a few words today regarding day 4 of the NEFA Virtual Symposium. Today's presentation will be on credit underwriting. We have a great panel lined up for you. Just want to say a few comments about our sponsors. Our program would not be available without our sponsors. Blair, if you want to advance things, thank you. Today's sponsors for our virtual symposium, diamond level includes Bank Financial, Channel Partners Capital, Providence Equipment Finance, gold sponsor, Financial Pacific Leasing, silver sponsor, New Lane Finance, bronze sponsor, LeasePath. So again, thank you so much for your support of the organization and helping us organize these virtual events in this very unusual time that we're all facing. Today's panel presentation sponsor is Providence Equipment Finance. I'm going to introduce briefly Dale Kluga. Dale has been in the commercial banking and leasing business for over 39 years. Dale founded Cobra Capital in 2000, which was later acquired by Providence Bank and Trust in 2016. Prior to Cobra, Dale founded Great American Leasing Company and LaSalle National Bank's leasing business. Dale also served as Chief Credit Officer at Link Scientific Leasing, then the largest independent medical lessor in the nation, and was managing partner of its third-party portfolio servicing business. Prior to that, he co-founded a de novo suburban community bank for LaSalle National Bank at the young age of 29, which was later acquired by Bank of America in 2007. A 1981 graduate of the Continental Illinois National Bank Wholesale Banking Training Program and its Financial Information Services Training Program, Dale is a CPA and graduate of Northern Illinois University in DeKalb, Illinois. With that, I'm going to turn it over to Dale.
Thanks, Chad. Can you hear me okay?
Yes.
Great. PEF is proud to be a diamond sponsor of today's NEFA Symposium. Providence Equipment Finance PEF is a division of Providence Bank and Trust, a $1 billion community bank organization located in the Chicagoland area. Providence is deeply rooted in lending to small businesses in the communities we serve and generously gives back to our communities through our stewardship program for Christian-based nonprofit groups by pledging 10% of our annual profits to those in need. PEF is the successor to Cobra Capital, a niche-oriented national equipment finance company serving small businesses across the nation since 2000. PEF continues the Cobra legacy success as an equipment generalist, which finances the equipment needs of highly successful entrepreneurs operating growth-oriented, small and mid-sized businesses located throughout the United States. We have a 35-year history of consistently funding third-party sources who originate equipment transactions in the $100,000 to $5 million range. We are a full financial statement shop and offer an app-only program for approved PEF originators. Our core 4 underwriting criteria focus on experienced management, essential equipment, growing revenues, and minimum debt service of 1-to-1. PEF is a counterintuitive and objective lender, which is distinguished by our highly successful earnings history through every economic cycle since its founding in 2000. Our trademark solutions that work approach to financing the equipment needs of young and growing businesses is how we creatively add value to every relationship we build for our originators, one deal at a time. So PEF is counterintuitive because we create solutions for those non-conforming credits, and we're objective because we fund for our own account and do not securitize. Go to the next slide there, Blair. Thank you. Our core 4 criteria listed here show our primary credit requirements and explains our successful underwriting history and our record low loss ratio of less than 1% cumulatively over the last 20 years. Next slide, please. Okay, I'd now like to introduce our moderator, Adam Peterson. Adam is a co-founder of Channel Partners and began his career in finance in 2009. As the vice president of sales, Adam has been instrumental in developing its current value proposition, business culture, and sales approach of the company. In addition to his sales leadership, Adam serves on the board of directors of the National Equipment Finance Association Adam graduated from Gustavus Adolphus College in 2010 with a BA degree in financial economics. Adam, it's all yours.
Thanks, Dale, and thanks, Chad, and also thanks to Providence for sponsoring the event. We have a great panel today to talk a little bit about credit, but the three main topics that we thought we would talk about would be customer user experience, some of the credit changes as we've gone through COVID when we shut down a little bit or tightened up a little bit, and then as we kind of expand back to the norm. And then the last thing that we'll talk a little bit about is future looking. How do we get back to some level of normalcy? But with that said, I'll introduce the panel. Chris Lerma is the Chief Risk Officer and the Head of Syndications for AP Equipment Finance. AP Finance is a small ticket independent finance company with approximately $400 million in assets under management. In this capacity, Chris oversees credit, syndications, and portfolio management operations. Chris obtained his CLFP designation and is highly active in the industry. He has served on the board and committees for the CLFP Foundation, currently serves as the trustee for the Chris Walker Education Fund, and is also a member of the Small Business Steering Council for ELFA. Kayla Perlinger has 9 years of equipment finance industry experience. She started her career as a credit analyst at Stearns Bank and later transitioned into other roles, including syndications analyst, data analyst, and a broker relationship supervisor. She joined Oakmont Capital Services in 2018 as syndications manager and was recently promoted to the VP of syndications. She currently leads the sell desk at Oakmont Capital and is highly involved in risk management and technology initiatives. Kayla earned her CLFP designation in 2016 and is currently a member of the Chris Walker Education Fund. And Katie O'Mara spent her career in the equipment finance industry with a focus on credit and risk. She recently joined Bank Financial's small ticket division as their vice president of credit. With that said, everyone, today we'd like to make this as interactive as possible. So if you guys have questions, feel free to use the chat box, or not the chat box, excuse me, the Q&A box, and we'll stop the panel and answer those questions on the fly and try and make it as interactive as we possibly can. But I guess we'll start with you, Kayla. In light of COVID-19, many lenders have reverted back to manual processes. We have deals that get kicked out for credit reasons. Are there other areas of your business that you have focused on refining or automating to provide a consistent user experience? That could be front-end process application changes or back-end processes. But would you talk a little bit about that at OCS?
Yeah, absolutely. So here at Oakmont, we're constantly asking ourselves how can we create efficiencies, and of course, how can we create a better experience for our customers? And at this time, of course, there's so many changes, so we really have to step back and ask ourselves, what part of the process are we able to control, and how can we expedite those parts of the process? And this could be anything from, adding technology throughout the onboarding process. And with that, you could create a smoother customer onboarding process, get applications to the underwriter at a faster speed. It could be creating APIs. So maybe right now you're manually pulling credit reports, peanut reports, Secretary of State's, adding those APIs to be able to automate those credit pulls. And really even just shaving off, let's say 5 minutes of an underwriter's time could really shave off that time on the applications and allow for an additional manual credit review if it is needed. And so as we're working out our credit process and throughout the whole operations, we're really trying to build a model where we can create some logic and determine to what extent do we need to underwrite a deal. So right now, industry, of course, is very important, and we've been very fortunate with a lot of the industries that we do financing for have been fairly unaffected by the COVID environment. So with us, we want to be able to create logic that states what industry they're in, what type of credit profile do they have, how much time in business do they have, to really determine what extent do we need to do for a manual process. So for right now, we do manually review each deal. It's really just to what extent do we need to conduct the review.
Katie, or Chris, do you want to talk about user experience a little bit at Bank Financial or AP?
Sure. Here at Bank Financial, being a young company, we're able to take advantage of that and kick off a full court press to work through automation efficiency so that we're ahead of the game when we are fully operational. We've been working with our software provider to improve some of the automation, the processes and workflows, so we can continue to provide the same level of service that our originators expect.
Yeah, I could add to that too, Katie. At the start of this pandemic, we really braced for the worst, and we actually laid off about 15% of our staff, mostly on the operations side, just thinking that we were going to see a huge decrease in volume. And actually, the exact opposite happened. A few of our segments actually benefited through this pandemic. So we saw a huge uptick in volume right as we shifted to having everyone work remote with a lot less resources than what we started out with. So we were left kind of scrambling around, just trying to keep up with the volume. Our team adjusted very well during this time. We put in a lot of hours, and we're still able to provide really good turnaround time. But what it really made us think about was our efficiencies in the current processes that we had in place. So we started to dissect our different front-end processes, from incoming application to funding. We've realized there's a lot of low-hanging fruit in providing a superior, more efficient customer experience. And it's not so much in automating the credit decisions, but more along the lines of processing the applications more efficiently, documenting and funding the deals more efficiently, using more automation, using more technology. So while most lenders have lost some efficiencies within the actual decisioning part of the process, I think through this pandemic and this work remote world, a lot of us have really started to gain more efficiencies by looking at our processes and looking at our systems a lot closer, which has helped maintain, or in some cases, helped improve the customer experience, even though we're slowing down on the decisioning process. So they say adoption of new technologies, which would have taken maybe 6 years, happened in the last 6 months. I think that's definitely the trend that you're seeing in our industry.
Absolutely. Well said, Chris. As you guys think about your current systems and scaling for the future, how are you constructing your systems today with an eye on flexibility with the systems in the future? Kayla, you maybe want to start with that?
Yeah, I can start there. And I think, the worst case scenario is you build this luxurious system and it works for the current environment and then completely breaks down or deteriorates if anything changes. So as we build out our systems, we're definitely thinking about that and thinking about not only what works now, but what will work in the future, what will work if, really anything changes in the current environment. So really, it's just the importance of being able to change even the logic in our system as our credit parameters change. It's the ability to, really be flexible and allow overall processes to change as we learn more about the current environment. And so, with the world we're living in now, things can change fast, and systems really need to allow for that flexibility.
Katie, how are you guys thinking about that at Bank Financial?
Similarly, during our discussions, reporting has been a hot topic. We anticipate that we're going to need to report on more criteria, the ability to slice and dice it in more ways than maybe has been typical in our line of business. So for every workflow change that we're talking about, we're also considering the reporting capabilities of the same. And really with a goal of building a system that can evolve as we evolve, as the economy evolves, and any other on-demand changes that we need to make.
Unmute myself.
Chris?
We've taken the same approach. I mean, we're very big on our system and the ability to have flexibility and being nimble and being able to change things within our system as our processes change. And also just having access to data. like what Katie mentioned, having the ability to access the raw data that you're capturing, being able to slice and dice it, being able to report on that internally rather than depending on a third party. So for us, again, having a robust system that's very nimble, that's very flexible, that allows you to actually use your data and easily have access to your data. So again, so you can actually use that data for your business going forward.
Yeah, and if I can just hop in quick, just in regards to flexibility, not only really do our systems need to be flexible, but in regards to customer experience, I think the people, whether it's in the business or your dealers, we all need to be flexible as well. I know at Oakmont, it's highly important for sales and operations and everyone in between to really understand the why of any changes that we're making. And the way we see it is, if they understand the why, they're able to explain it to their customers, to their dealers, and really prevent frustration and really add to a frictionless process.
Sorry, I was having trouble getting my phone off mute. Jared Keatman said that I was getting a little bit of feedback there, so thanks for that, Jared. Let's switch directions a little bit. Let's talk about some of the credit changes. And I know there's been a lot of panels throughout COVID about credit and how things are changing and how things are evolving. And that's not unique to any company out there. But in your models today, what kicks a deal out for manual review when it's coming through your system? And more specifically, when it's kicked out, what specifically are you looking at? What gives you the I'll call it the feel goods to continue to push forward, and what says, hey, we should stop, this isn't a transaction for us today? Katie, you maybe want to start with that?
Sure. So we're pretty much performing a manual review on all transactions that come in. We do use a scorecard as a tool rather than as a decision maker, but we do have different levels of our review. I think Kayla mentioned the same kind of philosophy at Oakmont. The areas we would spend more time on would be those industries that were impacted the worst at the onset of the pandemic, the states that had and are now re-implementing some of the most stringent restrictions. So those would be kicked out, that we would want to make sure that the transaction made sense. Regarding what we're looking at, I put more weight on personal leverage these days than maybe I had in the past. It seems the FICO models haven't quite caught up to that. They seem to be a little bit static right now. But as we all know, revolving debt load, it becomes much more important when you hit economic times like this. You want to make sure that they're not living or charging their living expenses. Inquiries, I think, is another area that is of concern. Right now, it's unique. I think we're seeing a lot more inquiries, at least I am, than we had in the past. I attribute that to the SBA and PPP loans. And it also seems as though creditors might be pulling credit on their revolving customers more. But the combination of the two is something that we're looking at now to make sure that they're not overextending themselves. The other area we look at differently right now is bank statements. I think the average balances don't hold as much weight as they had in the past. We know there's a lot of PPP funds sitting in the bank accounts. So the debits and credits hold a lot more weight than, again, maybe they had in the past. Are their revenues keeping up with their expenses? Are they going in the right direction? That's, I would say, kind of our biggest areas that we put more time into than maybe we had in the past, even despite what the FICO scores and the PayNet scores might be. I think you kind of had a multi-part question there. So regarding like what makes me comfortable, I mean, really, I think that's unchanged from maybe in the past. It's the same things, business and personal credit, meeting our minimum standards, essential use equipment, and does the transaction make sense?
I think that's great, Katie. We had one question that was emailed into Blair. that any of the panelists feel free to jump in and answer. But the question is, do you take into considerations businesses that have recent lost revenue and poor credit that were fine pre-COVID, or do you hold them to the same credit standards and pass on the opportunity?
I'd say this is a scenario we'd be more sensitive to today. I don't know that we would necessarily pass on it. I would look to see if the reduction in revenues was sustainable over a period of time as compared to their expenses. The credit could be a concern, but I think it would just require a more extensive review than maybe in the past.
Yeah, it's the same with us. I mean, it wouldn't be an automatic decline, but we would definitely be asking a lot more questions. Maybe ask for, if it's an application or a bank statement only, non-financial situation, maybe asking for 6 months of bank statements, 9 months of bank statements, just trying to see a bigger or longer kind of picture of their revenue, their monthly revenue stream. Yeah, just like Katie mentioned, would it be an automatic decline for us? So we probably would be more concerned about the poor credit than the loss of revenues, to be honest. But again, just like any downturn, a lot more sensitive to seeing a profile that's showing downward trends and has poor credit.
Yeah, I agree. And what we would also look at is, of course, how leveraged they are in addition to the requested financed amount. And I think that's where, as much as we're trying to get away from the COVID questions, we would really need to understand, why of, the revenue decreasing, and maybe there's a good reason for it, and they're completely fine taking out a $50,000 loan. But of course, if they're asking for $250,000, it's another story.
Mm-hmm. That's a good point.
So Chris, maybe I'll send the same question over to you that Katie talked about. You can talk a little bit about how you guys think about it at AP, but again, what kicks a deal out for manual review at AP today? And when a deal gets kicked out, what's important to you guys? Where do you go look at first?
Yeah, so we actually don't do auto scoring right now, but we have a number of business rules that would categorize an incoming application as high risk right now. So the things that we're looking out for right now are just what Katie mentioned. Everyone's looking at those highly impacted COVID industries, such as retail, hospitality, service-related industries. We're very focused in the industries that we play in. And fortunately, none of them have been highly impacted by COVID. So we don't see a whole lot of that. So within our industries that we are comfortable with right now, that aren't highly impacted by COVID, we're looking at the typical things that you would in any downturn. So we're going to be a lot more sensitive to highly leveraged businesses or individuals. So we're looking a lot closer to the debt to income ratio, leverage ratio, more sensitive to cash positions, like Katie mentioned. Cash is king in any downturn. And again, the tricky thing about analyzing cash and bank statements right now is that most businesses receive PPP money. And we do ask our customers if they did receive any PPP money and how much. We then try to take that information and discount some of the cash balances that we see to take into account that PPP boost. It's a little bit subjective, but we take kind of a reasonable approach to that. Also, we look to see if they had any deferrals in any accounts. So, if they receive PPP money and you see that most of their personal and business accounts have been on deferral and they're still not in a great cash position, then you need to start asking yourself why that's the case, and go back and get an explanation from the customer.
I think well said, Chris. Kayla, do you want to talk a little bit about how that's different at OCS, or how the same?
Yeah, very similar to Katie and Chris. What I did want to mention is we do a small manual touch at minimum on each deal. With that being said, we have a scoring model to determine really how much of a manual review is needed. Our scoring system generates a credit rating along what we call an OCSS score. With this, our credit analysts know what they really need to do. And then, of course, as always, we take into account, private bankruptcies, liens, judgments, past due accounts. What we look at a little bit more than in the past is the amount of revolving debt as well as the percentage available. Of course, if it's $2,000 and they're tapped, it's a lot different than if it's $50,000. As Katie had mentioned, looking at the bank statements, any indication of a PPP loan, we want to understand, why they took it out. And, it doesn't mean we won't do the deal, but we do want an explanation on file as to how the customer was affected.
Yeah, it's interesting that you mentioned, paying attention to the revolving, which, we do too, just like any downturn. But it's a little different from the last downturn where I see, a lot of our customers are actually paying down their revolving versus it going up. And I think I know it's a combination of all the stimulus that's been kicked in, the deferrals. So a lot of these customers that really weren't highly impacted, which is most of the customers that we see, they've been using this time to actually pay down some of their debt. So, and that's reflected in the FICO scores that you see today. There was an article in the Wall Street Journal talking about FICO. The average FICO was the highest it's ever been since, I think it was the last 7 or 10 years. This is despite unemployment being the highest it's ever been, and incomes and business revenue going down. And that's just a function of, again, with all the stimulus money, with all these different lenders on the commercial and on the consumer side deferring payments. Customers, despite what's going on, are still making their payments, and they're actually using some of this money they have to pay down their existing debt, which are boosting scores. So it's giving you a little bit of a false score, which is one reason why we're giving a little bit less weight to FICO scores and looking a lot more at the data within the personal credit report.
I think well said, Chris. We do have a question in the chat box. It's from Randy. It said, my question is, once the government assistance ends, such as PPP, how do things look longer term? Who wants to take that one first?
I guess I could take that question. I don't. I think it all depends on the virus. I mean, this is something that I was going to discuss in the future, looking, things that we look out for. But if this virus gets under control, a vaccine is made available to the general population quickly, and there's no stimulus, which I think there will be a stimulus. It's just going to take a while. I think things are going to be fine. But again, if there's something changes with the release of the vaccine and, everyone's still hesitant to go out and spend money, through next summer, then it could be a big issue. But it is one thing that we're paying close attention to is this second round of government stimulus, how much it'll be, when it'll be approved, and where that money will go to. I personally, I'm very confident that there will be a second round of relief. I don't think, because there's strong bipartisan support for it, but I just don't think it's going to happen this year. I think it will happen early next year. So I'm not too concerned about it. Our organization isn't too concerned about it. But for whatever reason, if this doesn't happen, then I think all lenders are just going to look at those businesses that are highly impacted by COVID, the restaurants, the anything hospitality related, service related, and they're gonna, if they're not already exiting those markets, they will exit those markets or be extremely conservative.
Katie, Kayla, anything you guys would like to add to that question?
No, the only minor thing I would add is, we're of course monitoring it just like everyone else, but to add a positive spin to it as well is, I agree with Chris that I think there will be a stimulus. It's just, the question is when. But what I also wanted to say is, I've been so impressed with the businesses and how creative they're able to be, and navigating through this and finding a way to still do business. So it may be as much of a doom and gloom as it may appear to be. I feel like so many businesses are really doing a great job continuing on and getting creative to generate that revenue.
That was the point I was going to add is we've really seen how resilient people can be. I think at the onset, some projections of what charge-offs were going to look like. I think a lot of people projected much higher than what actually occurred, which is a positive. It allows us to go into, if there is a second round, with at least having a little bit of knowledge this time. In the spring, we all went into it, none of us having ever experienced anything of the sort. So it gives us a lot more leverage if we have to do it again.
Great. Let's move on to the next question. In today's environment, obviously, turnaround times and SLAs are all different from what they were pre-COVID. But what are realistic turnaround times or SLAs in today's environment? And as a third-party originator that's maybe sending you guys deals, are there things that they can help with to help improve those SLAs? And I'm thinking along the lines about write-ups and more information, or what things can they do to help the lenders have better turnaround times or SLAs?
Okay, do you want to go?
Sure. I would say as an organization, we remain committed to honoring the turnaround times that we originally set out with. We don't intend on adjusting them, which is why we've started this focus, or an enhanced focus, on creating some system efficiencies and automation. With that being said, I know there's probably more times where we're going back to the originator to ask questions that maybe we hadn't in the past. So, you could argue that will affect the turnaround times. I think from my standpoint, that what would help the most to try to keep them moving through the system is, and it's something I ask all the time, my guess is it's every credit analyst's instinct is to say, why? Why are we receiving this request? Why does the customer need the equipment? All the questions that justify essential use. I feel, again, it comes kind of naturally, but in today's environment, it may not be as natural. It may not be as obvious, and it might be more we might know the why, we may not know the why now, of why, why are they getting this now? Do they need it right now? Does it make sense for their industry, where they're located? And I think that's probably my most important question that I need answered when I'm reviewing a request. I know, we've all tired of the COVID statements by now. We get the same responses on every one of them. So I don't think it needs to be as formal as maybe it had in the spring, but, a write-up to help us know what's going on, what the nature of the request is, and help us understand the essential use of it.
Yeah, absolutely. And at Oakmont, we're able to hold a lot of our A, B to even C paper so we can control that process. So we've tried to keep the turnaround as consistent as possible. And, whether it's prior to COVID or post-COVID, we want that turnaround time to be consistent. And, if that's the least we can offer the customer to, keep the normalcy, we're going to try to do that. With that being said, we do transfer some one-off transactions to our funding partners. And I think an important area there is making sure your analysts know each funding partner and what they're looking for, not only to submit the deal, but to approve the deal. And another thing is to make sure your sales reps understand that, where we've tried to train our sales reps to not only know what we're going to approve in-house, but what our one-off partners are also going to approve. And we've seen it where they're talking to the customer, they understand the credit that we're most likely going to see, and they'll, jump ahead and ask for bank statements, or they'll get financials, or they're almost, they're anticipating us to send it to a particular funding source. And so we can then package the deal and submit it instead of having all that back and forth.
Yeah, I think that's key, Kayla. I mean, we're doing the same thing. We're, just as I mentioned, the things that we're looking for today, we're making sure that we communicate that to our sales reps, making sure they understand, like, hey, if the cash balances don't look good, and you see that when you have the conversation with the customer, ask them. When you see that they took on, their pay net shows they have, a ton of debt they've taken on over the last 12 months, ask them why they took on that debt. So just, training our reps on what credit is sensitive to today. So they could go ahead and, ask the customer those questions and have an explanation upfront to credit has been very beneficial. So I think it's, it is key to make sure you communicate and train your reps on things that credit is looking for, your funding sources are looking for, so they could be proactive.
So the last question we had in our credit section, and Chris, I'll direct this one to you. I know you talked a little bit about this in our meetings, but how is structuring deals impacting the transaction of the application flow, and what are the customers' receptivities to it today?
Well, I don't think customers are I would say the first couple of months when the pandemic hit, there was a lot of pushback on structuring for those not so great credits, but we're not getting, I think most customers at this point understand they're not in the dark. They know that we're in a recession. There's, economic uncertainty. And even though their businesses may not be highly impacted, the economy and the industry as a whole might be. So there's extra hoops to jump through, or they may be asked, to put more money down. So overall, I mean, in our segments that we've played in, I mean, customers have been fairly receptive to it, and we've just had to adjust a lot of our processes. And again, this is a training issue with the reps. Like, if the credit doesn't look good, like, given the uncertainty today and everything going on, like, be proactive and ask your customer if they have any money to put down on the equipment, before credit declines it, and then the rep coming back and making the argument like, well, what if the customer had this amount of money? So just training the reps to be a bit more proactive. The interesting thing about structuring in the past 6 months is, again, because our customers haven't really been highly impacted by COVID, and they've received a lot of PPP money, we're having a lot of customers voluntarily want to put money down on their transaction. So they're requesting to put a large down payment, advance payment of the contract. And again, I think this is just a combination of customers receiving the PPP money and being conservative and just wanting to manage their debt load. So we've also seen a higher rate of early termination payoffs, again, for the same reason. Customers just want to pay down debt. They're in a good cash position and they're not really impacted, and just being a lot more cautious.
Perfect. Kayla, anything? I know, Katie, you had said that you guys don't necessarily structure deals very, very frequently. Kayla, anything on structure at OCS?
Not too much. A lot of our AB transactions, we've been able to, be consistent, and we haven't had to structure them because of the current environment. We have had to get a little more creative on the C credit front, but as long as the customer understands why, you need to mitigate that risk, we haven't had any issue, with the customer understanding.
Okay. So let's switch to the future looking side of things a little bit. One of the questions that we always talk about at Channel Partners, and I know we spent a lot of time on this when we were putting the panel together, but what are we watching today that would cause us to pull back? I mean, I know across the industry, we're pushing hard to kind of get back to what we were doing pre-COVID. But you're seeing spikes. I mean, Kayla and I happen to be in Minnesota, which basically got shut down again last night. But what are we watching for today that would cause us to start to pull back to where we were in March or April? Maybe we'll start with you, Chris, on that.
Yeah, sure. Well, the obvious thing is the virus. The virus is still very much in control. So the virus situation, doesn't get any better, we'll need to step back and again and reassess the markets that we're in, or the markets that we're thinking about entering or re-entering, and figure out what adjustments will need to be made. As I mentioned, luckily most of our segments were not highly impacted by COVID, but there is the indirect impact of further lockdowns, which would cause continued elevated unemployment rates, which would lead to less consumer spending and just really put a damper on the recovery of the economy. I think most of us are still highly optimistic the worst is behind us and things can only improve in the short term. But if the virus is not contained and news on the effectiveness, or the release of the vaccine changes, and something, a vaccine doesn't get out to the later part of 2021, then lenders will need to take a step back and possibly make some material adjustments to their business. So with that being said, I'm very hopeful and confident that an effective vaccine will be available sooner than later. But again, it is something that could really, force us to take a knee-jerk reaction and pull back suddenly. The other thing, which we talked about earlier, is just the second round of government stimulus. Depending on what segments that you're playing in, you're lending into, it could have a huge impact if a stimulus package second stimulus package doesn't get passed, or if it takes, a long time while we're seeing rising cases and further lockdowns. Most of the stimulus programs have expired. There's a few programs, that are set to expire at the end of this year. So again, like I mentioned earlier, a lot of the boost that the government has provided is gone. And now we're in the middle of a, second or third spike in COVID with further lockdowns. So again, I'm very confident that a vaccine will get out soon, and a second round of government stimulus will happen sometime next year. But the unlikely scenario where the virus just continues to spiral out of control, there's delays in getting a vaccine out, and lawmakers just can't get a stimulus package together. I mean, it could be a huge setback with the recovery. So again, very unlikely that scenario will play out, but that's one thing that that would make us, and I'm sure everyone else, pull back quite a bit.
Kayla, you wanna talk a little bit about how you guys think about what would cause you to pull back?
Yeah, so we're definitely, we're positive and hopeful that things will continue to improve. With that being said, we're also realists that we need to, kind of monitor, is there going to be a stimulus? When is it coming? What's the unemployment rate? Just understanding the current economic conditions, and not only at a high level, but really digging into how is it affecting each industry that we're currently in. And, just like Chris, we've been very fortunate with industries that we do business in currently, and they haven't been too affected. However, we need to continue to monitor that, as that may change as, if the stimulus gets delayed, or if any other factor comes into play. Another thing, of course, we actually, to kind of get a little off topic, but we've been, looking at technology to even monitor, our current portfolio, and, to really get a notification, for example, if any of our customers have filed bankruptcy, or, have gone through any recent liens or judgments. Or so it's not only about, it's about monitoring your current portfolio, but it's also about, chasing the business, or, what industries are you going to get into. So it, at a high level, it's about monitoring the economy, but we also need to dig into so many different areas further. Oh, Chris, I think you're muted.
What are some of the programs that you're looking into to get notifications and to monitor, your portfolio with bankruptcies, tax liens, and such?
Yeah, there's a few different technology products that we were looking into. I'd have to go back to give you a name, but it was, we were very interested in it, especially, not even throughout this time, but, anytime. It's nice to be able to monitor your current portfolio. We don't hold a lot of our paper internally, but we are looking to grow that. And so the importance of being able to monitor that will continue to increase.
Interesting. Katie, do you want to talk a little bit about how you guys evaluate the future, or what would cause you guys to pull back at Bank Financial?
Sure. I think Chris summed it up pretty well regarding the vaccine and a stimulus. I would say, what we would look at kind of more in the short term as we wait for that occur, if it doesn't happen as quickly as we hope, is not even just the industries who were initially impacted, but that trickle down effect. That hasn't. I think that's a lot of why we didn't see the startling numbers of default early on, is that the people behind the restaurants, the suppliers to the restaurants, they didn't have the effect. It wasn't, or they didn't have the impact the way the restaurants did. They were still able to keep it moving. If this carries on longer, then it might start to affect them and then just become a domino effect. So I think, we will be looking at that as well, depending on the timing of a vaccine or the stimulus.
Yeah, I could tell you, like right now, Adam, organization of data is key, and you and I had actually talked about this, but, having direct access to your raw portfolio data and having the ability to easily manipulate, slice and dice it is huge right now. I was probably looking deeply at our portfolio data, maybe every month, maybe once a quarter, because everything was going fine. But now I find myself looking at the data every month or maybe twice a month, getting more granular and getting more granular with the reports that I'm doing in my analysis. So, having a system that is capturing all the data that you need, organizing it, and also a system that is giving you access to the data, the raw data that you actually need so you can report on it, is big right now. I mean, it's huge in being able to quickly make adjustments to your underwriting policies on the fly. So I think, again, going back to the first question that we were talking about with technology, again, it reinforces the importance of having a robust system that has a process, that has the ability to build out robust processes, capture data, and having easy access to your data is very, very important for a lender managing a portfolio, especially during this time.
Yeah, I think well said, Chris. As you guys look at 2021, how has access to equipment affected your customers? And I think more about supply chain, or are they able to get the trucks or the pieces of equipment that they need to operate the business? And how does that factor into your 2021 volume forecasts today? Maybe start with you, Chris.
Oh, go ahead.
Sure, I could start. It's actually our biggest issue at the moment. We have a lot of demand in our core industries, but we're just scrambling around trying to find equipment. At the start of the pandemic, most dealers canceled orders or really cut back. Manufacturers were shut down. The whole supply chain was just disrupted. And all of a sudden, there was some clarity on which industries, weren't going to be impacted. And shelter in place, lockdown orders were lifted. So everyone jumped back in and put their orders back in. So there's a huge backlog right now in a lot of different sectors. So in many of our equipment segments, there's a lot of catch up being done right now. It's starting to smooth out. So I don't anticipate it being a long-term issue. And if anything, for our 2021 numbers, I think it's actually actually boosting our 2021 projections, just because the demand that that we're having this year and customer applications and approvals where there's no equipment on the contract will just be delayed to next year. So customers are still going to need that equipment. It's just they're not going to get it this year because it's not available.
Yeah, I agree, Chris, with the 2021 projections. We, have current applications or approved applications that are just sitting out there, waiting for the equipment to be completed. So if anything, it'll affect our year-end 2020, but actually improve our 2021. With that being said, as far as it improving, we've had some manufacturers that, are starting to play catch up and, knock equipment out, but we still do have other manufacturers or dealers that, are, very far behind. So the customers are kind of waiting on that equipment. The fear is, as they start to play catch up, what if there's another shutdown, or what would happen that, impacts that and prevents them from accelerating that production.
Katie, do you have anything you wanted to add to that?
Yeah, I mean, I would say as a young company and only recently having launched, we haven't run into that, or at least not to the degree that it's made its way back to me. But, I would imagine we would have the same set of concerns or, successes, in early 2021 when everything caught back up.
Chris, I know this wasn't on our list, but as you think about your customers right now that maybe can't get a truck this year or can't wait until next year, how has the used market changed for each of you guys? And are you evaluating the used equipment differently than you did 6 months ago?
Yeah, that's a good question. Used prices obviously have gone up. So, we're cautious that, we're buying at the peak for used equipment. We have laxed some of our used equipment, guidelines. And again, this is just wanting to take care of our customers, understanding that our customers are trying to opt for new equipment, but, their only option is used equipment. So we are making a lot of exceptions to used equipment right now in the industries that, we know well. To accommodate the current situation that we're in.
Kayla or Katie, are you guys seeing kind of an influx of used equipment as well? And how do you guys evaluate that?
Yeah, we do a lot of financing for used equipment, and I would say it probably has increased because of the lack of production supply. With that being said, we're fairly flexible on used equipment, as long as it values out and it makes sense for the price. And of course, like Chris said, the price may be a little bit higher now than, we'd see in the past. However, again, we're fairly flexible. So I don't think it has changed, our underwriting process, but it probably has increased the number of used units we have in our portfolio.
Mm-hmm.
Yeah, and again, not having a past history here at Bank Financial to compare it to, we do a decent amount of used equipment though, and would follow the same process of verifying the comparables and making sure that we're not overextending and putting ourselves in an upside down collateral situation.
Good. Anything else the panelists would like to add? Well, maybe, man, we got a couple extra minutes here. Anybody else in the audience have any questions you'd like us to address? Can leave it open for just a minute to see if anybody types anything in. Doesn't look like anything's coming in right now. I'd like to thank the panelists. It's been fun. I've known Kayla and Chris for a number of years, and Katie, I think this is the first time we met. But over the last month, it's been really fun getting to know you guys more and talk about credit. So thank you guys for taking the time to be a part of this panel. Other than that, maybe we'll turn it over to Blair.
Thank you, and thank you, Adam, for moderating, and Kayla, Katie, and Chris for joining us today. We really appreciate your perspectives on this and enjoy you as panelists. And we're thankful at NEFA to have all of you and your expertise. So thank you so much for taking the time to be here today. This is actually the end of our virtual funding symposium. It has been a pleasure. We've had some wonderful panelists and keynotes, and we're so thankful for everyone that has joined us and sticking with us. And we'd much rather be in person, but we're doing the best we can to kind of keep everyone together and keep the information flowing. A very big thank you to Stephanie Hall and Andre Clifford of Bank Financial, our co-chairs for the virtual funding symposium. We could not have done this without them. They helped to cultivate all of the education and our panels. So we all owe them a very big thank you for bringing these people together with us today. And we want to tell everyone about December 10th, we are having a virtual holiday meetup. We're asking everyone to wear their ugliest sweaters, and that will get you in a raffle for a Amazon gift card. So we hope to see you in December. Thank you so much for joining us for the virtual funding symposium, and have a great afternoon.
Thank you.